Welcome to our deep dive on escaping the negative equity trap. Today, we will walk through exactly how to break free when you owe far more on a vehicle than it's worth. Like owing $19,000 on a car worth only $8,000. As we move forward, you'll learn why high interest keeps you stuck, what actions actually change your trajectory, and how to avoid decision pitfalls that make things worse. To maintain momentum, we will also include practical steps, visuals, and quick quizzes to reinforce learning. Let's get started, and first, lay out our roadmap. First, we will define negative equity and why it matters. Next, we will explore how high interest rates like 18% APR keep you stuck. Then, we will discuss an aggressive principal attack strategy and a complete financial overhaul to inject income and reduce expenses. After that, we will address the behavioral side and accountability, followed by why voluntary repossession is so damaging. Finally, we will present a clear roadmap to reach positive equity and test your understanding with quick quizzes. Before we proceed, please note this content is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique, so consult a qualified professional for personalized guidance. Any figures used are illustrative estimates to demonstrate the concepts. Here is the core problem. At an annual percentage rate of 18%, daily interest is accruing, which means a large portion of each minimum payment goes toward interest instead of principal. Consequently, balances barely move month to month. Therefore, small adjustments won't fix this. You need decisive action to change the math in your favor. Let's clarify the situation. You owe $19,000 on a vehicle that's worth only $8,000. That means you're underwater by approximately $11,000, which is your negative equity. With an 18% APR, interest accrues daily, so minimum payments mostly cover interest. As a result, you see almost no progress on your balance. However, when you direct extra money specifically to principal, the balance falls more quickly. In turn, less interest is charged each day, which accelerates your path to positive equity. Now let's get tactical. The minimum payment keeps you stuck. Therefore, pay at least double or even triple when possible. Crucially, designate all extra funds to be applied to principal only. Additionally, automate your extra payment to happen on payday to remove friction. Between paychecks, consider sending small micropayments directly to principal when you can. Finally, allocate windfalls such as tax refunds, bonuses, or proceeds from selling items to reduce the principal immediately. These steps directly change the math by shrinking the balance and the daily interest. To support aggressive payments, overhaul your cash flow. First, implement a zero-based budget so each dollar has a specific job. Next, add income quickly through a second job, extra shifts, or gigs such as driving, delivery, hauling, or freelancing. If possible, use the vehicle itself to generate income to fund the principal attack. Meanwhile, sell non-essential items to create a cash stockpile aimed at the loan. Additionally, reduce expenses by shopping for lower insurance rates, switching to a cheaper phone plan, and negotiating recurring bills. Furthermore, cut discretionary spending such as subscriptions and dining out. Then, automate the minimum payment and manually send an additional transfer to principal after each paycheck. Finally, avoid taking on new debt so your progress isn't undermined. Consider a simplified example. With a minimum payment, roughly 60% or more may go to interest initially. In contrast, when you add extra payments to principal, you immediately reduce the balance. Consequently, the daily interest charge declines, which increases the portion of each subsequent payment that reduces principal. Therefore, correct allocation of payments creates a positive feedback loop in your favor. When you double your payment, interest becomes a much smaller portion of each payment, and most of your money goes to principal. As a result, the balance declines more rapidly, which further lowers the interest in future months. This creates compounding momentum in your favor. If you can manage triple payments, even temporarily, the acceleration is even more dramatic. Comparing the options, voluntary repossession typically results in the lender auctioning the car for a low price, leaving a deficiency balance that you still owe. In many cases, lenders sue for the deficiency, which can lead to garnishments or judgments. Additionally, your credit reports will reflect this event for many years, slowing your recovery. Conversely, by paying aggressively, you regain control. Once you reach positive equity, you can sell the car privately for more than the loan balance, close the debt, and transition to a reliable, low-cost vehicle. This approach protects your credit trajectory and keeps options open. Here is your practical timeline. Initially, you stabilize your budget and add income while sending double payments. Then, as the interest portion shrinks, you maintain automated payments and keep intensity high. Finally, once the balance falls below the vehicle's market value, you enter positive equity and can sell privately to exit the loan entirely and transition into low-cost transportation. This sequence prioritizes speed and financial protection. These figures are illustrative to show directionally how extra payments accelerate progress. At a minimum payment of around $450, progress can be very slow and sensitive to interest and fees. Doubling to $900 can reduce the estimated months to positive equity substantially. Tripling shortens the timeline further. A well-timed lump sum payment amplifies results by dropping the balance immediately, which reduces ongoing interest charges. Your actual numbers depend on your exact APR, fees, and lender terms. Quiz time. The question is, when you pay extra each month, what should you explicitly instruct your lender to do with the additional amount? The options are: 1. Apply it to next month's payment. 2. Apply it to principal only. 3. Hold it in suspense until payoff. Or 4. Split it evenly between interest and principal. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is: apply it to principal only. This ensures the extra money reduces your outstanding balance immediately, which lowers future interest charges and shortens the path to positive equity. Here is another quick question. What is a likely consequence of voluntary repossession? Your options are: 1. It removes all debt and fees. 2. It improves your credit score. 3. The lender may sue you for a deficiency balance. Or 4. It freezes interest and collections immediately. You may pause the video now to consider the answer. We will cover the correct choice in the next section. The correct answer is that the lender may sue you for a deficiency balance. Voluntary repossession typically leads to an auction at a low price and the remaining deficiency, plus fees, still being your responsibility. This harms your credit trajectory for years. To recap, high APR minimum payments trap you in interest. Increasing payments to double or triple changes the allocation and speeds up principal reduction. To sustain this, you must add income and cut costs. Avoid voluntary repossession to protect your financial options. Once you reach positive equity, sell privately and transition into a lower-cost vehicle. Finally, maintain discipline and accountability to prevent repeating the cycle. As we conclude, take immediate steps. First, call your lender to ensure extra payments are applied to principal. Next, automate double payments if feasible, and schedule small additional payments between paychecks. Then, list items you can sell, and complete those sales promptly. In parallel, shop for lower insurance and renegotiate bills to free up cash. Also, choose a side hustle you can begin within 2 days to boost income. Finally, track your principal balance weekly to stay motivated as you see tangible progress. Thank you for watching. If this video helped you, please like, share, and subscribe for more practical financial strategies. In the comments, share your plan for reaching positive equity and what step you will take today. Your story could inspire someone else to take action.